Hello, welcome back to class. We'll be looking at lease accounting and employee benefit, lease accounting and employee benefit in this module. And in doing that, we will look at the nature and classification of lease. We'll look into lessee accounting and the lessee accounting and the lessor accounting. We will look at short-term and low-value lease. We will also look at employee benefit scheme, the defined contribution and defined benefit plan, and lastly the actuarial assumption and disclosures. This module actually covered two critical financial reporting areas, which is lease accounting IFRS 16 and employee benefit, which is IAS 19. And the IFRS 16 brings most lease onto the balance sheet, improving transparency and comparability. And as for the IAS 19 for employee benefit, it provides guidance for accounting for employee benefit, especially complex defined benefit plan, and both standard requires significant judgment, estimation and professional expertise. For lease accounting, the key principle, just like I said, is in the IFRS 16. A lease conveys the right to control an identified asset for a period in exchange for consideration, and lessee recognize a right of use asset and a lease liability at the commencement date, and the lease classification for lessor remain as either finance lease or operating lease, and for the short-term and low-value lease qualifies for optional exemption under the IFRS 16. The lessee account is actually let's look at the initial recognition, and at the commencement a lessee measure one, the lease liability, that is present value of future lease payments discounted using the incremental borrowing rate or implicit rate. Also the right of use asset, which is lease liability plus initial direct cost plus estimated restoration cost minus the lease incentive received. And an example of this is if lease payments are 5 million per year for 5 years at 8% discount rate, then the liability is actually approximately 19.96 million naira. The lessee accounting, and as per the subsequent measurements, and after commencement, the right of use assets, under the right of use assets, it have to be depreciated over lease term or useful life if ownership transfer. And for lease liability, it's increased by interest expense and reduced by payments made and effective interest method. And the journal entry includes depreciation, interest expenses and lease payment entry each period. For the lessor accounting, which is finance versus operating lease, for the finance lease, it's actually it transfers substantially all risk and reward of ownership, and the lessor recognizes assets, recognizes lease receivable, and recognizes selling profit loss, and income recognition as finance income over lease term. And for the operating lease, the lessor retain risk and reward, and the asset remains on balance sheet. This income is recognized on straight line basis. Looking at the employee benefit, which is IAS 19, an overview of it, it's actually categorized into short-term benefits, post-employment benefits, other long-term benefits, and termination benefit. For short-term benefits, these include wages, paid leave, bonuses, and they are recognized when earned. And for post-employment benefits, there are pension, health care after employment, and for other long-term benefits, there are long service leave and sabbaticals, and lastly, termination benefits. These are actually redundancy or early retirement payments. Let's bring a difference between defined contribution and defined benefit plan. The defined contribution plan is actually that which an entity pays, the fixed contribution which is paid to a separate fund by an entity, and there is no further obligation. An expense equals contribution that was being paid. And for defined benefit plan, it's the entity promises specified benefit and bears the actuarial and investment risk on it. And complex measurement using actuarial assumption and present value calculation is used under the defined benefit plan. For the defined benefit plan accounting, 3 components of defined benefit plan showcases, and these include service cost, which is recognized in the profit and loss, and the net interest on net defined benefit liability, which is recognized also in the profit and loss, and the remeasurement, which is actuarial gain or losses, which is recognized in the other comprehensive income. And the net defined benefit liability is equal to defined benefit obligation minus fair value of plan assets. The actuarial assumption and disclosure. There are key actuarial assumptions, and this includes 1, discount rate, which is based on high quality corporate bonds. There is also the salary growth, mortality rate, and healthcare cost trend. And the disclosure requirements include reconciliation of obligation and plan assets, components of expenses, and sensitivity analysis of key assumptions. In conclusion, IFRS 16 and IAS 19 are essential for transparent financial reporting of lease and employee obligation, and both standards requires careful judgment in measurement, classification, and disclosure. Having a mastery of these areas ensures accurate representation of liabilities and expenses, supporting informed decision by users. And ongoing development in lease modification and demographic trends continue to shape their application. Thank you for listening.